Welcome! If you've ever wondered how to invest in stocks but felt overwhelmed by all the information out there, you're in the right place. In this video, we'll break down the basics of stock investing, step by step, so you can start your journey with confidence. Whether you're looking to grow your savings, plan for retirement, or simply understand how the stock market works, we'll cover everything you need to know. Let's start by understanding what stocks are and why people invest in them. Stocks represent ownership in a company. When you buy a stock, you're essentially purchasing a small piece of that business. Companies issue stocks to raise money for growth, and investors buy them hoping the company will do well, increasing the stock's value. Stocks are traded on exchanges like the New York Stock Exchange or NASDAQ. Understanding this basic concept is the first step to becoming a successful investor. Next, let's look at why investing in stocks can be a smart move for your financial future. Investing in stocks offers the potential for your money to grow faster than traditional savings accounts. Over the long term, stocks have historically provided higher returns compared to other investments like bonds or cash. They also help you stay ahead of inflation, which can erode the value of your savings over time. Of course, stocks come with risks, but with the right strategy, you can manage those risks and build wealth. Now, let's talk about the different types of stocks you might encounter. There are two main types of stocks, common and preferred. Common stocks give you voting rights in the company and the potential for dividends, while preferred stocks usually offer fixed dividends but no voting rights. Some companies are large and well-established, known as blue-chip stocks, while others are smaller and may offer higher growth potential but come with more risk. Understanding these categories helps you make informed choices. Next, let's explore how you can actually buy stocks. To buy stocks, you'll need to open a brokerage account. This is an online platform that lets you purchase and sell stocks. Many brokers offer easy-to-use apps and websites, making it simple for beginners to get started. Once your account is set up, you can deposit money, search for the stocks you want, and place your order. It's important to compare fees, features, and educational resources when choosing a broker. Now, let's talk about how to research stocks before you invest. Before investing, it's crucial to research the companies you're interested in. Look at their financial health, recent performance, and future prospects. Read annual reports, check news updates, and review analyst opinions. Pay attention to key metrics like earnings, revenue, and debt levels. The more you know about a company, the better your investment decisions will be. Next, let's discuss the importance of diversification in your stock portfolio. Diversification means spreading your investments across different companies, industries, or even countries. This reduces the risk of losing money if one stock performs poorly. By owning a mix of stocks, you can balance potential losses with gains from other investments. Diversification is a key principle for long-term success in the stock market. Let's see how you can build a diversified portfolio. To build a strong portfolio, start by choosing stocks from different sectors, such as technology, healthcare, and finance. You can also include international stocks for more diversity. Consider your risk tolerance and investment goals when selecting stocks. Rebalance your portfolio regularly to maintain your desired mix. This approach helps you stay on track and manage risk effectively. Next, let's talk about the difference between short-term and long-term investing. Short-term investing involves buying and selling stocks quickly to take advantage of price changes. This approach can be risky and requires constant attention. Long-term investing means holding stocks for years, allowing your investments to grow over time. Historically, long-term investors have seen better results due to the power of compounding and market growth. Decide which strategy fits your goals and risk tolerance. Now, let's look at how to set clear investment goals. Before you invest, it's important to define your goals. Are you saving for retirement, a house, or your child's education? Your goals will influence your investment choices and risk tolerance. Write down your objectives and set a timeline for each. This clarity will help you stay focused and make better decisions. Next, let's discuss how much money you should start with when investing in stocks. You don't need a lot of money to start investing in stocks. Many brokers allow you to begin with small amounts, sometimes as little as $10 or $20. The key is to invest only what you can afford to lose and avoid using money meant for emergencies. Start small, learn as you go, and gradually increase your investments as you gain confidence. Now, let's talk about the costs involved in stock investing. When you invest in stocks, there are some costs to be aware of. These include brokerage fees, commissions, and sometimes account maintenance charges. Some brokers offer commission-free trading, but always read the fine print. There may also be taxes on your profits, known as capital gains tax. Understanding these costs helps you maximize your returns. Next, let's look at the importance of patience and discipline in investing. Successful investing requires patience and discipline. The stock market can be volatile, with prices rising and falling daily. It's important not to panic during downturns or get greedy during booms. Stick to your plan, Review your portfolio regularly and avoid making impulsive decisions. Over time, disciplined investors tend to achieve better results. Next, let's discuss the role of emotions in investing. Emotions can have a big impact on your investment decisions. Fear may cause you to sell during a market dip, while greed might tempt you to take unnecessary risks. Recognize these emotions and try to make decisions based on logic and research, not feelings. Having a clear plan and sticking to it can help you stay calm and focused. Next, let's look at the importance of continuous learning in stock investing. The stock market is always changing, so it's important to keep learning. Read books, follow financial news, and take online courses to improve your knowledge. Stay updated on market trends and new investment strategies. The more you learn, the better equipped you'll be to make smart decisions. Next, let's talk about the risks involved in stock investing and how to manage them. All investments come with risks, and stocks are no exception. Prices can fluctuate due to company performance, economic changes, or global events. It's important to understand these risks and be prepared for ups and downs. Diversification, research, and a long-term perspective can help you manage risk effectively. Next, let's look at the concept of risk tolerance and how it affects your investment choices. Risk tolerance is your ability to handle losses without panicking. Some people are comfortable with higher risks for the chance of bigger rewards, while others prefer safer investments. Assess your own risk tolerance before investing. This will help you choose stocks and strategies that match your comfort level. Next, let's discuss the importance of having an emergency fund before you invest. Before you start investing, make sure you have an emergency fund. This is money set aside for unexpected expenses like medical bills or car repairs. An emergency fund gives you peace of mind and prevents you from having to sell your stocks in a hurry if something goes wrong. Aim for 3 to 6 months worth of living expenses in your fund. Next, let's look at the basics of stock market orders. When buying or selling stocks, you'll encounter different types of orders. The most common are market orders and limit order. A market order buys or sells immediately at the current price, while a limit order sets a specific price at which you want to buy or sell. Understanding these order types helps you control your trades and avoid surprises. Next, let's talk about dividends and how they can boost your returns. Dividends are payments some companies make to shareholders from their profits. Not all stocks pay dividends, but those that do can provide a steady income stream in addition to potential price gains. Reinvesting dividends can help your investments grow even faster over time. Next, let's look at the basics of stock valuation and how to determine if a stock is a good buy. Valuing a stock means figuring out if it's a good deal at its current price. Investors use metrics like the price to earnings, P/E ratio, price to book, P/B ratio, and dividend yield to compare stocks. These numbers help you judge whether a stock is overvalued or undervalued. Always compare a company's valuation to its peers and industry averages. Next, let's discuss the importance of staying updated with market news. Keeping up with financial news and company updates is crucial for investors. Markets can react quickly to new information, so being informed helps you make timely decisions. Follow reputable news sources, subscribe to financial newsletters, and set up alerts for your stocks. Staying updated ensures you're never caught off guard by major events. Next, let's look at the role of professional advice in investing. If you're unsure about investing, consider talking to a financial advisor. Professionals can help you create a personalized investment plan, explain complex topics, and guide you through market ups and downs. While there may be fees involved, good advice can save you money and stress in the long run. Next, let's discuss the importance of reviewing your investments regularly. Regularly reviewing your portfolio helps you stay on track with your goals. Check your investments at least once a year, or more often if needed. Look for changes in company performance, market trends, or your own financial situation. Rebalance your portfolio if it drifts from your target allocation. This keeps your investments aligned with your goals. Next, let's talk about common mistakes to avoid when investing in stocks. Many beginners make mistakes like chasing hot stocks, ignoring fees, or failing to diversify. Avoid trying to time the market or making emotional decisions based on short-term news. Stick to your plan, do your research, and focus on long-term growth. Learning from others' mistakes can save you time and money. Next, let's look at the benefits of starting early with stock investing. The earlier you start investing, the more time your money has to grow. Thanks to the power of compounding, even small investments can become significant over many years. Starting early also gives you more time to recover from market downturns. Don't wait for the perfect time, begin as soon as you can. Next, let's discuss the impact of taxes on your investment returns. Profits from selling stocks are usually subject to capital gains tax. The rate depends on how long you held the stock. Short-term gains are taxed higher than long-term gains. Dividends may also be taxed. Understanding the tax rules in your country helps you plan your investments and avoid surprises. Next, let's look at the importance of record keeping for investors. Keeping accurate records of your investments is essential. Track your purchases, sales, dividends, and fees. Good record keeping helps you file taxes correctly and monitor your progress toward your goals. Many brokers provide statements and tools to help you stay organized. Next, let's discuss the role of index funds and ETFs in stock investing. Index funds and ETFs, exchange-traded funds, are popular ways to invest in a broad range of stocks with a single purchase. They track the performance of a market index, like the S&P 500, and offer instant diversification. These funds often have lower fees than actively managed funds. They're a great option for beginners who want to invest without picking individual stocks. Next, let's look at dollar cost averaging as an investment strategy. Dollar cost averaging means investing a fixed amount of money at regular intervals, regardless of the stock price. This strategy reduces the impact of market volatility and helps you avoid trying to time the market. Over time, you buy more shares when prices are low and fewer when prices are high. It's a simple, effective way to build wealth steadily. Next, let's discuss the importance of reviewing your investment strategy periodically. As your life circumstances change, your investment strategy may need to change too. Review your goals, risk tolerance, and portfolio regularly. Adjust your investments if you experience major life events like a new job, marriage, or retirement. Staying flexible ensures your investments continue to meet your needs. Next, let's look at how to avoid scams and protect your investments. Unfortunately, scams and frauds exist in the investment world. Be wary of promises of guaranteed returns or too good to be true opportunities. Only use reputable brokers and never share your account details with anyone. Protect your investments by staying informed and cautious. Next, let's discuss the value of patience and the power of compounding in investing. Compounding is when your investment earnings generate their own earnings over time. This snowball effect can turn small, regular investments into significant wealth. The longer you invest, the more powerful compounding becomes. That's why starting early and staying invested is so important. Next, let's look at how to handle market downturns without losing confidence. Market downturns are a normal part of investing. Prices may fall due to economic changes, global events, or company news. Don't panic or sell in a hurry. Instead, review your plan, stay focused on your long-term goals, and remember that markets usually recover over time. Downturns can even be opportunities to buy quality stocks at lower prices. Next, let's discuss the importance of setting realistic expectations. It's important to have realistic expectations about stock investing. Not every investment will be a winner, and there will be ups and downs along the way. Focus on steady, long-term growth rather than quick profits. By keeping your expectations in check, you'll be less likely to make impulsive decisions. Next, let's look at the role of technology in modern investing. Technology has made investing easier than ever. Online brokers, mobile apps, and robo-advisors let you manage your investments from anywhere. Use these tools to track your portfolio, research stocks, and execute trades quickly. Embrace technology to stay informed and make smarter decisions. Next, let's discuss the importance of security and protecting your investment accounts. Protecting your investment accounts is crucial. Use strong, unique passwords and enable two-factor authentication whenever possible. Be cautious of phishing emails and never share your login details. Regularly monitor your accounts for suspicious activity. Security is a key part of successful investing. Next, let's look at how to set up automatic investments for convenience and consistency. Many brokers allow you to set up automatic investments where a fixed amount is invested on a regular schedule. This makes investing easy and helps you stay consistent, even if you're busy. Automatic investing also supports dollar cost averaging, reducing the impact of market ups and downs. Next, let's discuss the importance of reviewing your investment fees periodically. Investment fees can eat into your returns over time. Review your broker's fee structure and look for ways to minimize costs. Choose low-cost funds and avoid unnecessary transactions. Even small savings on fees can make a big difference in the long run. Next, let's look at the value of community and learning from other investors. Joining investment communities, forums, or clubs can help you learn from others' experiences. Share ideas, ask questions, and stay motivated by connecting with fellow investors. Just remember to do your own research and not follow advice blindly. Community support can make your investing journey more enjoyable and successful. Next, let's discuss the importance of staying adaptable in your investment approach. The investment world is always changing. Be open to new ideas, strategies, and technologies. Adapt your approach as markets evolve and your personal circumstances change. Flexibility is key to long-term success. Next, let's look at the importance of celebrating your progress and milestones as an investor. Investing is a journey, and it's important to celebrate your achievements along the way. Whether you reach a savings goal, see your portfolio grow, or simply stick to your plan, take time to acknowledge your progress. Celebrating milestones keeps you motivated and reinforces good habits. Next, let's summarize the key steps to successful stock investing. Let's quickly recap the key steps to investing in stocks. Understand what stocks are, set clear goals, open a brokerage account, research your investments, diversify your portfolio, and stay patient. Remember to manage risks, keep learning, and review your strategy regularly. By following these steps, you'll be well on your way to becoming a successful investor. Next, let's look at some final tips for beginners. Start small, stay consistent, and don't be afraid to ask questions. Focus on long-term growth rather than quick wins. Use technology and community resources to support your journey. Most importantly, enjoy the process and keep learning. Investing in stocks can be rewarding if you approach it with patience and discipline. Now, let's wrap up with a motivational message for your investing journey. Congratulations on taking the first step toward investing in stocks. Remember, every great investor started as a beginner. Stay curious, keep learning, and don't let setbacks discourage you. With time, patience, and the right strategy, you can achieve your financial goals and build a brighter future. Happy investing!